Welcome back. Glad you could join us for the latest episode of My Private Network. I'm Bob Simpson, your host. This is the second episode in our due diligence series. Wealth Stewards, our wealth management firm, oversees portfolios for high net worth individuals, functioning as both portfolio manager and as an investment funds manager. We're obligated to conduct thorough due diligence on all investments we utilize, and we take this responsibility very seriously. As an investor, conducting interviews with investment managers can be very challenging. That's why we leverage My Private Network to give you the opportunity to listen in and hear directly from people managing your money. In our process, we employ two types of due diligence interviews: initial calls, during which we determine if an investment meets our standards for allocating client funds, and quarterly calls, which help us stay informed and decide whether to maintain, add to, reduce, or exit an investment. Today's guest is Sean Rogister. Sean is Chief Executive Officer for Cortland Credit. In his role, Sean oversees the investment management while ensuring the integrity of the firm's policy is grounded on Cortland's core beliefs. He has more than 20 years of experience leading investment teams in fixed income strategies that included private lending exposures in emerging and developed countries around the world, having built and led investment management businesses at world-class financial institutions, most notably managing the fixed income asset class for Ontario Teachers' Pension Plan, which manages over $100 billion of assets. Sean possesses a global and institutional perspective, as well as possessing the unique knowledge base of how to manage successful debt-based investment strategies. We've been working with Sean and Cortland at Wealth Stewards since 2017. It is one of our largest positions in our Stewardship Alternative Income Fund. Average return over that period has been over 6%, which is really exceptionally strong considering that's been through a period of very low interest rates. But that doesn't mean that we should sit on our hands on this investment. Today, we're going to do a full DD call to get updated and share with you, our audience. So Sean, that's the intro. Did I do an okay job there?
Well, yeah, fantastic job.
Fantastic job. Yeah. Well, thanks for joining us again. You've been a regular on My Private Network. So it is a long process to go through a DD interview. So let's just kind of rapid response. We want to hear full responses, but let's kind of keep it tight and cover off on the main things. So if you're ready, let's get going.
I'm ready.
So question number one, can you provide an overview of the company history and founding? You've talked stories about, and I think it's even on My Private Network, about starting above a bike store or something. Just give us a little flavor as to where this company started and what was behind your idea to start the company Cortland Credit.
Yeah, so Cortland Credit was started in 2013. It was founded by Bruce Shirk and I. I came from a background running institutional capital on the fixed income side at Ontario Teachers, and when I was at Teachers, I was very careful not to make sure that we had a good diversified strategy, and I identified that to be about good risk-adjusted returns that were uncorrelated. And when we drilled into what were the areas that had the best risk-adjusted returns, it was very consistent that it always came back short-term secured private debt. But it's hard to do this because you can't just go knock on a door and say, hi, I want to lend you money. There's a lot of skill into what the legal documents are that support this and how to do the due diligence. So you had to work with other managers. We invested in about 5 different firms. My board required that I sat on the board of the companies that we invested in, because as a board member, you get whatever information you ask for, and they have to give it to you. So I like the transparency side. We also got to know the principals well. One of the firms we invested in was being run by Bruce Shirk. When I left Teachers and Teachers sold that investment, it was bought by another, specialist in asset-backed securities on the lending side, and so he was free. We started up Cortland, and since then this has been our flagship fund and the focus. It is now going into its 11th year. We started taking capital in September of 2013, and we're going to be on our 11th year after the end of this month.
So if we look at, there's is really you and Bruce who started the firm. What have you done? What's the ownership of the company look like right now?
Well, it's still 100% employee owned. There's one more significant shareholder who happens to run the business development side, James Kelly. The rest of the firm, we compensate them very well, and we have a long-term incentive program that is tied to the top line revenue growth of the firm. So we think it's a good structure. It is, managed as a exempt market dealer and portfolio manager in several provinces across Canada. We've also expanded to incorporate a Cayman fund, division for offshore investors that are not Canadian and want to have that alternative. And we've recently expanded operations in the U.S. As we've been regularly involved in lending in the U.S. And we're seeing a lot of interest, and we're finding, despite the expectations that market is huge and everybody's doing everything down there, we are finding that we do not have a lot of direct competition, even in the U.S., for the short-term asset-based lending model. So we see a lot of growth for that side there, as well as continuing to grow in Canada.
Yeah, a year ago, right around this time, I attended your 10th anniversary. And,
Yeah.
Over the years, I've met many of the people at your firm. I'm trying to think of the number 33 or something employees last year is my guess. But where are you now on employees?
We're at 38. We have really 5 divisions, and in each one of those divisions, it's led by a small senior team that is very experienced in this space. So there's operations, takes a lot of skill to do all the oversight of all the banking and treasury relationships with all of our borrower clients. On the risk side, it's a background that's very good at doing a deep dive into appraisals and valuation of the firms and any liquidation requirements that we might see in the future. And of course, on the portfolio management side, you're doing a deep dive on underwriting all the time. And you've got to be able to bring in these assets. So you have to be able to originate them. We've recently expanded on that side in the U.S. as well. And of course, the business development team has to be able to explain what is a little bit more complicated than traditional bonds to investors, mostly institutional. We're about 80% institutional and maybe 20% retail, with a few family office groups and high net worth individuals built into that. But I can tell you that all of them want to do a deep dive into making sure they understand the portfolio risk. And we offer them full transparency, whether they're a retail investor or institutional, whatever information they need to understand the risk in the investment. I think the best model in my mind is to open it up from a transparency perspective, and that allows them to have comfort that we're doing things right.
You've always been very open with us. When we've seen or thought we had identified an issue, we give you a call, we get an answer right back. So that's one of the things we appreciate. How does your firm make money?
Well, we have 2 sources of economics. The first one is the management fee, and that's a traditional management fee that portfolio managers charge. Ours is 45 basis points. But we also have a unique strategy that is focused more on revolvers as the majority of our portfolio. We also do term loans for a smaller part, but those revolvers take a significant amount of work. We do weekly calls with the treasurers. We're evaluating the borrowing base regularly. We still do quarterly reviews of all of the appraisals and understanding what the risk is. We do monthly reviews of financials to make sure they're in line with all the covenants, such as how much leverage they have in the corporation, and making sure they're in compliance with all our rules. And then we do semi-annual and annual field exams. And so all that requires a little bit of work. We're reinventing the portfolio all the time. We have economics that are 170 basis points, 1.7% annualized, that is charged to the fund. But we look at it as to where that's kind of a cost structure or a cost-based model, because we've identified it costs 1.5 to 2 points to run this business. And since we grew past about 100 million in assets, we grew to scale, and it's been consistent since then. So the real component and what you'd see on a management expense ratio is the 45 basis points.
Mm-hmm. Now let's just talk about, I think your portfolio is pretty concentrated. Um, can you just talk a bit about a typical profile of a borrower that you would work with?
Yeah, concentration would be, across the 30 to 35 companies that we currently have in the portfolio. That's some concentration, but that's belied by the fact that with most of the portfolio, it is accounts receivable backed borrowing base. We lend to companies based on the amount of collateral they have and the liquidation value of that collateral, and what percentage of that we will take as the amount that we will be willing to lend to them. So, 80, 85% of accounts receivable, 50 to 65% of real estate, 50 to 75% of inventory, and things like that. It's a various types of scales that we'll build in on that side. But because there's thousands of accounts receivable in this portfolio, in addition to the 30 to 35 borrower names, it is much more diversified than you think. Now, that being said, and Bob's going to address it, there's one larger concentration above 10% in the book, and that one is one that we have since changed the guideline to say we cannot have more than 10% in any one single name, but that was after the fact, and we're working very hard to reduce that, and we have a lot of channels to do so, and we're working on that.
Yep. One of my favorite phrases is that's why we diversify, right? Not everything is always going to go your way. And when things go sideways, it's always good to have a broadly diversified portfolio. Um, Now, one thing I know, because it's in all of your marketing material that comes out, is really there are three major phrases uh, that you talk about when you're managing money: senior secured, short term, and asset based. Just touch on those three, and just so everybody gets a complete understanding of what you mean by that.
Yeah, so senior secured is we're always at the top of the capital structure. And this is a very important term from a legal perspective when you're in a financial distress situation. The courts are very clear that if you have a claim on the accounts receivable, you've identified that they are sourced from purchase orders from the accounts receivable counterparty, and you have proof of delivery that they've signed off on. You've got a legal claim on that accounts receivable, and that gets paid out first in a court process where there's enforcement. And so we're always senior secured on that. Any of the fixed assets, property, plant, and equipment, we're always named as the senior borrower, and no one else can lend against that asset without entering into an intercreditor agreement with us where they're subordinate to us. So that is very strong. And then the other side is that we are short term, which means in the world of fixed income, under 2 years. And our loans are a year to a year and a half long, with renewals built in, sometimes 6 months or 1 year renewals, but we have to mutually agree with the borrower. And then it's usually one or two. And then after that, they've got to set up a new agreement with us. But along the way, we always have liquidation rights with them that gives us a ability to say we're not going to finance any further. And even on the accounts receivable financings, we approve the borrowing base at our discretion. So we're really clear that we have a lot of controls if things go aside, and they have to do so in a short period of time. So very liquid from the point of view of traditional non-liquid strategies other than public securities. And then you have asset-based, which means that we always have assets that we've identified and in most cases registered in our name as collateral for our loan. And that's just like a home on a mortgage. No one else can lend against that property without the approval of the top line senior secured lender. And that's us, and no one else can come in front of us. And it's a very important part of this. So senior secured, short-term asset-based lending.
That's your game.
Yeah.
Okay, we get I think it's a monthly report that you send out, and I'm looking at the July 31st report. says 33 credit facilities, senior secured 99.97, asset based 95.54, floating rate you're 99%, uh, estimated portfolio utilization. What do you mean by that?
So we're doing revolvers, and the borrowers have a right to have some kind of seasonality in their portfolio. So the average is that we might have committed to $1 billion and change of loans to these borrowers, but right now they're only using 820 million of the cash.
Yep.
Because across that book, some might be 100% utilized, some might be 90, some might be 75 or 80.
Yeah. So and that was a problem in the past when you were carrying, uh, when you had cash in the portfolio and rates were zero, right? Today.
And I'm just smiling because you have a long memory, Bob, and that's very accurate. So we had a very big set of borrowers that repaid us all at once at the end of 2020, and we had a bunch of new investors come in 2021. So as a result, and this was in the middle of COVID, all of a sudden we had a slowdown in how quickly we could get lawyers to come into their office or get involved in doing the analysis and writing up the documentation. It took us a lot longer than we expected. We put in place some rules that said we will never be above 15% cash again. But at one point in the middle of 21, we were a little bit over 40% cash. So it was very dilutive for us. It was not because of bad loans in the portfolio, but just an unexpectedly large amount of cash. And we had to build in some structures so that can't happen again.
Right. And we talk about annual, upfront due diligence calls like this. We talk about quarterly calls. I think we were calling James Kelly every other day saying, how come you're only 3%? Like 3% is not what we were expecting. And that was the description that we had. But, part of our responsibility as investment managers is to have a long memory. We don't forget, right? So you were, one of the things that I've always been a big fan of is lending against receivables. At one point in my career, I actually worked with a company that did credit insurance, where we were insuring those receivables against non-payment. Listening to what you're saying, what percentages is factoring in your portfolio?
Well, factoring is a term where the sole collateral is the accounts receivable. But in our model, we have a claim against the borrower as a big part of it. We always look for the borrower to be responsible for debt service. But if they don't, then we have a fallback where we have excess collateral above the value of our loan, even after liquidation, to get paid back for our investors. So that's kind of, our model is a little different from factoring. It's a lot more like what the banks do with their own money on their loans. So, but in the case of lending against primarily accounts receivable, which is over 60% of our book now, it's because we have one larger loan on the term side, and there's a bunch of small term loans. But over time, it's moving to, like right now, we have a bunch of new loans that we're looking at reviewing towards doing our underwriting process and putting them through towards potentially investing in them, and they're over 80%, even over 90% revolvers. So we're moving to a model that is less term and more revolvers, and that's where we have an edge in the market, because it's really hard for the banks to do the weekly calls with the borrowers, and to have a team that understands how to do that collateral analysis that we do in our group really efficiently. Accounts receivable based financing is where you check on the quality of the accounts receivable counterparty. A good example is in the IT sector, where they are looking at providing, they buy computers from the big manufacturers, IBM or Dell or HP, and a value-added reseller has to step in the middle and reconfigure those to suit the client. So they'll sell to, there's one group that sells to Harvard Endowment Fund and Yale University and Standard Bank out of the Northeast. And that group of buyers is in every month buying another large server. But they pay 90 days later. So the cash flow management of that IT firm has a challenge in front of them in terms of managing that while paying all their staff, and we help them through that. But the counterparties to the collateral are exceptional and very rarely miss a beat. And that's the case in most accounts receivable financing, and certainly in our model where we do a lot of work on checking on the credit quality of the accounts receivable counterparty.
Yeah, preservation of capital is paramount in your model, isn't it?
Yes.
Just talk about what if you didn't do a great job of managing the loans, making sure you're being paid, keeping your portfolio out of trouble, how how bad could that be for Cortland Credit?
Well, an example would be accounts receivable counterparty. And I've seen this from people I know that work for the banks. It was a loan was approved by the lending manager, but then the operations team didn't do their work. So they would lend against a pool of accounts receivable, but they didn't check that the prior lending amounts against accounts receivable had the collateral turnover, that it had been paid back. And so if you allow for the accounts receivable to go past due and you still continue to use that as collateral, the liquidation value of that drops off quickly, because obviously the accounts receivable counterparty is not that good. They're not making their payments. They're not paying for their goods that they bought. What our model is much more about looking for repeat buyers of the same good or service that borrower manufactures, produces, and delivers. So that is a much better model. It's more efficient. We don't have to do as much real adjudication of the counterparty to the accounts receivable. We just check that and we do monitor, is that someone we've seen before? Is that still an investment grade pool of accounts receivable counterparties? But if it is, then it's about how much do they have available in accounts receivable. If it's an 80% advance rate against $25 million funding commitment, they can only borrow 20 million. If they want to borrow 21, it's not available to them. And so, we make sure that we're very clear with them on how we do that. We do a full reporting with them. And because we do those, we'll do a selection of the accounts receivable and do an audit of it. And because we do a constant check of the financials where we look at their monthly financials and they say, yeah, I just collected on 2 million of accounts receivable. But we'll say, well, we see the online bank statements. We're not seeing that cash flow show up. Can you point to us where it came in? And then we could include it in the borrowing base. But anything that we don't see, that we can't confirm, that's past due, it's almost like 2020 hindsight on the quality of the collateral. We can say that's not in the borrowing base, that is not available to you as a source of collateral. And that's a very strong approach. And that's how we do it.
So, Sean, in your July 31st report, you showed one investment that was described as a first lien, senior secured, short term loan and revolver to a Saskatchewan energy firm at 24%, plus a similar loan, same province and same energy sector at 5.5. Now, this stands out prominently as most of the others in your top 10 are in the 3.5 to 6.6 range. Can you just explain that to us as to what your thinking is and your positioning on that position?
Yeah, so the first loan is our largest borrower. It is a refinery in Saskatchewan. It did go through a working capital pinch and had to raise additional capital behind Cortland. However, the decision was made after watching them for a while to initiate a controlled sales process through CCAA, which is the Companies Creditors Arrangement Act that they have established in Canada. With the process, the courts require additional capital to keep the firm operating. And Cortland took this on to protect the overall exposure, because what happens is it becomes first lien in the courts process to support the working capital requirements of the borrower during the court process. So we took that on to make sure no other creditor could step in front of us during that court process. Subsequent to coming out of the CCAA process, it was added to our loan, and that's why it grew from, I think it was 13% at the time, up to 18%. And it has since grown a little bit more, but relatively marginally so. We're working to reduce the collateral. We're working very hard on it over the next, and we think it'll occur over the next 1 to 2 quarters. And we are, we also have instituted a single name limit of 10% for any single name going forward, and have other processes to make sure that that is very rigidly maintained. The other refinery is a group that does, they use used engine oil to create ultra low sulfur, which has, very low carbon footprint diesel. And that's a completely separate entity. It is in the same province, it is in the same sector, but it's completely separate entity.
Right. So basically you discovered in your portfolio that there were some issues, you dealt with them. Your current feeling about them is that going to be a problem for performance of the fund or no?
Well, we are very, first of all, very much a hands-on manager. So we do go through workouts with a heavy involvement. We work very closely with the courts. We work very closely with the lawyers that they appoint to go through the receivership process. And any accounting firms, we just are, as the senior lender, we're first at the table on that, but the courts have to set the process, and we work closely with what they come up with. In this case, it continues to be a heavily over-collateralized loan. We're confident that it will be, that there's no deterioration in the assets. We did go through an extensive process with our auditors, KPMG, at the end of last year and finalized in March of this year, where we reviewed the portfolio and came out with their input saying that it should be marked as is at the face value of the loan without a discount because of the excess collateralization. And it is now operational. It is generating the diesel product to the specifications required by that industry. And we believe that it is going to be a successful process and bring in other lenders because it's an operating entity and therefore much easier for them to value.
Right. So you're continuing to work with them and have a plan, and you're working the plan.
We are working very closely with them and very closely with that plan.
Okay. Now, I was also reading just recently, maybe even a couple of days ago, that there was an article that popped up that said Cortland Credit Group announces successful repayment of credit facility for Insulation Technology Group. Just wondering why you would make such an announcement.
Well, it was because it was one of the larger sort of success, one of the more interesting, successful transactions in our books. It was a group that used our capital to acquire the third largest manufacturer of the ceramic insulators that are used in all the high voltage wiring in Europe. And that was in August of 2021. And then in November of 21, the same private equity group acquired the second largest manufacturer. So they became the largest in Europe, and they had a lot more pricing power. The total of kind of $10 million in euros that they put into it turned into a sale of the business at 450 million. So we saw it as an example of why borrowers really like working with us. Even though they would have had a difficulty sourcing bank capital at the time because it was relatively small firms that had some uncertainty in the predictability of positive EBITDA, and just coming through COVID and all that kind of thing, the banks were much more reluctant to jump into that. Because we knew the firm, because we knew the collateral structure, and because we had first claim and all the key assets, we were able to provide the financing, and it was a very successful loan, indicative of why companies come to us to help fund their growth. So we just saw it as indicative of why borrowers like us.
Next thing I'm looking at is, it's good to look at some of the issues that have caused you trouble, but to just spend a couple minutes and talk about the process that you follow when you're underwriting new loans.
Yeah, it's a very important 4-step process that we are pretty clear on, that it has several stages that require unanimous support by the credit committee, and that process is rigorously reviewed by the independent review panel. So when a borrower comes to us, our team does some initial review with them to make sure it fits with our model. We are fairly industry agnostic, but if it doesn't suit our environmental, social, and governance standards, if it doesn't suit our general criteria for the quality of the management team, then we won't put it in the portfolio. If it creates overconcentration in the portfolio, we won't we won't accept it, and it won't get past stage one. That's stage one. Sign off requires unanimous support from the 4 members of the credit committee. They're all very experienced individuals. It's myself and the other co-founder of Cortland, Bruce Shirk, and then the head of risk and the head of portfolio management. So we're too busy with all the activity here. If one person doesn't like it, that shuts off that loan and it gets put aside, and we don't fund it. If it gets past stage one, we do a deeper dive into the financials of the borrower. We want 3 to 5 years of history of accounts receivable and who the buyers of their good or service were. If they're repeat, they come back many times. If it's got a relatively consistent generation of positive earnings, that's a good fit for us because it's efficient for us to monitor. We have a lot of information on that borrower going into it through the financials, through the accounts receivable counterparties. We know their business, and then we'll that generally it looks like the kind of fit to get past stage 2, again requiring unanimous support by the credit committee. And if we get past that, we'll issue a term sheet. The credit committee meets and agrees on the rates that we're going to charge, any unique steps in the due diligence, any guarantees or other unique characteristics of the assets we require. And that once we issue that would only come with unanimous support of the credit committee. If they sign it back, we get a check from them to start the due diligence process, generally in the $50,000 to $80,000 kind of range to cover legals and initial appraisals on all the key assets, the field exams, etc. And then we jump into a deeper dive, confirming the financials, we do a site visit in all borrower cases. We always do a thorough review of their key assets, including getting appraisals on those key assets and goodness and appraisals of quality of earnings. And then we'll do a dive into the statements by their legal and accounting teams to make sure the representations and warranties clearly state that this business is what the borrower says it is. And if that is all in place, we'll issue a funding commitment, which is very consistent with the term sheet, but with a lot more details on it. And if they sign that back, we start funding.
So if you look at, how many loans go in the top of the funnel and how many come out at the bottom, like what percentage of, are you looking at, for every 10 loans that you look at, you write one of them, or what's that ratio approximately?
Yeah, it's I think last year was particularly tough because we saw a lot of loans that a higher percentage of them didn't necessarily meet our criteria. We saw about $9.8 billion worth of loans last year, and we approved 250 million of them. So a little bit more than 2%, but it's a rigorous process. There's a lot of work that goes into it. There's a big underwriting team that has to review those components, and it takes about 6 to 8 weeks to get from stage 1 to stage 4.
Yep.
But with all that being said, we target in the 5 to 10% range historically, just because of the process that's required.
So you do a lot of work, very rigorous, as you described it. What is your debt history?
So we do, we are in the private lending business. We do have some bad debts. I know that in fixed income, people don't spend a lot of time talking about how good all the things are. They talk about what went wrong because, fixed income's like that. You don't participate in the upside of the borrower. You only get participation in the downside if they're unable to meet their debt obligations. But we do have some bad debts. We've got, I believe there's 8 of them historically where there's been defaults, and that they have in about half the cases, they did not result in any loss. In one case, it was a $20 million loan, was repaid down to 10, and then 5 million loss was taken on the balance. And that was because it was in the cannabis industry, and that entire industry was collapsing as we were going through that process. But outside of that, the losses have been basically to cover administrative costs of going through the default process. So really, loss given default has been quite low.
Right. So as we've looked at the portfolio, we've talked about what you've got there. As we take and look, instead of in the rearview mirror, we look out the windshield. What do you see in the portfolio that are the major risks in the portfolio?
Well, right now we have a higher concentration in fixed term assets. They're under 2 years. They're sort of 12 to 18 months, but we are 62%. We target going forward to be in the 75 to 80%. We think we're going to get above 70% this year, and we are going towards the revolving loans that are the major part of our portfolio. They're much more dialed into our form of risk management processes. So we do a lot of work on tracking accounts receivable. We have a whole team that approves the borrowing base of accounts receivable on a weekly basis. It's a differentiating characteristic of our firm, and it's key to our collateral management and analysis and identifying triggers. And we can stop funding at any point in time and just let the AR wind down and collect on that, because we always have blocked accounts that give us first cash distribution from any collection of AR. And we monitor their online bank statements so that we know what the cash is going through that firm. So very close attention to detail with these borrowers. And the revolver is not only a key differentiator for us, but also a model where we have a lot of expertise and a lot of comfort in managing that risk. I think that's the key. It also gives you good diversification at the borrower level, because they can come from any sector. And at the same time, it's much higher diversification because you can have hundreds or thousands of accounts receivable underlying that, giving you a much more diversified collateral base. And we're good at monitoring that. So that's the general picture on that side. We do have an expectation, as I said, that the single large name in the portfolio will be significantly reduced, if not, over time. We're comfortable with the risk, but we think it's just too high a concentration. And we change the limits to reflect that. But going forward, we will not allow that breach to happen.
Yeah. So Sean, one of the things that we're working on on this podcast is doing a live event called the Investing for Income Summit. So it's really targeted at the baby boomer who is looking to find better alternatives than putting their money in GICs at 3 or 4%, or riding the equity roller coaster when they don't really have the time frame to be able to recover losses if we do go through a negative period. Who would you describe, thinking at the individual investor level, who's an ideal client for this particular fund?
Yeah, it's a very good question, and we think we're a little bit unique as an alternative investment manager in that we're very conservative, and we have a long-term strategy that's expected to reflect this model for years to come. And we see a lot of opportunity to grow the business through the high demand from this type of borrower. So as we bring in capital, we think this is going to be a good story for investors for years to come. It is good income. It is well above the traditional income of short-term or revolving and floating rate loans that are out there. It is a unique strategy, and there's not a lot of investment alternatives that are as short-term as this and first lien asset-based loans. Mm-hmm. So it's a great diversifier for the portfolio and very strong as a contributor to a portfolio that is made up mostly of traditional fixed income assets. So we see that as being, the characteristics where it's a long-term strategic asset mix for investors that are looking for something that has good income, reliable income in their portfolio.
Yeah. So we did an episode, I don't know, a couple of months ago where it was talking about bond funds and, how your traditional bond funds have returned not much over the last 3 years, and you're paying fairly high fees for no return. Compare investing in this fund to a bond fund.
Well, a bond fund is a fixed pay pool of assets that, unfortunately are going to see returns deteriorate if interest rates rise. They will also see returns rise if interest rates fall. And right now we're in kind of the middle of the range historically. So they could fall a little bit, especially in an environment where the central bank is easing on the monetary policy side. But the interesting thing is that the central bank eases affects short-term rates. It doesn't affect long-term rates. And if the economy is going to be growing very well, you tend to see the longer-term yields rising. If it's going to be really slowing, those yields will tend to fall because everybody thinks the central bank is going to have to support it. But the economy has slowed, but it's not in a recession. And so there's a story that says interest rates could fall a little bit in the bond side, but it's always going to be that long-term fixed coupon side. Ours is floating. It's a very good diversifier. The yields that we earn are significantly above traditional fixed income assets in almost all scenarios, except when interest rates are falling very quickly, and that'll tend to be a temporary situation. So this is always going to be something that, in my view, that adds positively to the overall return of the portfolio and is a very good diversifier with low volatility and very good risk-adjusted return. So it's good value in a portfolio.
Yeah. So sort of wrapping up now, looking at performance, I took a look at, let's say, your F class and looked at performance, and performance was pretty steady between 2017 and 2020 in the 5.5 to 6% range. But 2021, I know that your pal James there was phoning me all the time saying, yeah, rates are low. Right now, we're only coming out with like a 3.5% return. But as rates go up, we're going to recover from that. And then since then, we've seen really good returns. I think the last 1 year number I saw the end of July was 8.4. So just talk a bit about performance and what investors should be expecting or anticipating, maybe not expecting.
Yeah, the other thing James said to you was that we had a higher cash balance in 2021 because we had a large group of borrowers repay us all at once at the end of 2020. And a lot of new investor capital came in early 2021. And in the heart of COVID, it was harder to get deals done and hard to get the new deals come in the door because everybody was unsure how to operate with no staff coming into their offices and things like that. So the business growth model that is normally characteristic of the firms that approach us, they were struggling with identifying what the forecast was. So we were a little slower on that side. So cash got built up and that diluted returns. We've since put in limits that we cannot take in new cash unless cash is under 15%. We set a target of 5 to 10. So I don't think that low return due to dilution from excess cash can happen again. But going forward, what we do see is that there is some decline in interest rates because the central banks are being a little more concerned about slowing growth, and especially as inflation has declined. So they're not worried about stopping out inflation. They're more about they can bring the economy back to normal levels in terms of the monetary policy rates. And so we see an environment where our returns are pretty steady in this level or as a spread over the short-term rates. And that's traditionally why we add value, is because it's significantly above those short-term rates, which are still above the longer-term yields that are available in traditional bond markets.
Mm-hmm. Now, you're also, and I know one of the things that we've talked a fair bit, and James has been calling about, is you're looking at doing an equity-linked version of your fund. Do you want to talk about that, or what do you think? Should we just have you back and talk about that in a where you can go deeper and talk about that entire concept? What are you thinking there?
Well, I'm happy to do either or. I would just do, a 2-minute summary, or the elevator pitch is that this is the first time Cortland has brought out something that has the ability to generate equity-like returns. And it uses our overall private credit portfolio and the conservative income that it generates. And we set a minimum target of 5%, which we have very consistently outperformed, except 2021. And that minimum return is, I think, a solid return for investors. But anything above that has been applied towards paying for an option up front that will give you an at-the-money claim on the upside in the stock market. So if interest rates the price of those stocks that are in that equity side rise from here, this will participate fully in those, and it's got a lower cost of lower management fee with some 10% participation in the upside above 5%. So it's a little different strategy. It is different from other strategies like that out in the market because it has unlimited upside if the underlying stocks do well. And in this case, we focused on the ZEB ETF, which is an index of 6 major banks and the performance of their stock. And that sector has been underperforming recently, but historically the banking sector has been one of the strongest performers in the Canadian capital markets. And we think that that's unlikely to be a case going forward, that it underperforms. We think it outperforms very well. So it's got a target return in the sort of 12 to 16 or 17% range, kind of 14 to 15% mid that we expect this strategy to generate. And it's a fixed allocation over 3 years. So it's a little different than our traditional portfolio, which gives you redemption rights in 45 days notice. This is a fixed hold, but it has the ability over that period to earn what we think is a good annualized rate, as I said, in the 14 to 15% range over the period.
Yep. So good stability, but now you're targeting equity returns rather than just floating rate returns. So yeah,
and generating the income from the underlying assets. Yeah,
and generate the income. I also saw that there was an upcoming release of the Cortland Credit offshore fund for investors who are looking for better tax efficiency. When are we going to see more information about that?
Well, it's just been finalized, so we can now take in investor capital for a Cayman-based fund for those who have the ability to invest out of that regime. So it does provide the earnings that fund makes are always passed through to investors, but it's in a regime where the tax treatment is applicable to it. And it's available now. The minimums are a little higher than the 5,000 in our existing fund. I think they're in the neighborhood of 100,000. I think that's the right number. I'll have to check on that, but get back to you on that side. But yeah, it's for investors that want that offshore exposure when they've got that built into their family office or other strategic investment plans.
Yeah. Okay, perfect. So this, one of the things about these due diligence interview calls, they are pretty long. So just kind of final thoughts before we wrap up, Sean?
Well, I would say that, first of all, we greatly appreciate this opportunity. It's been a very thoughtful set of questions that we've always received from you, and we love the opportunity because we're all about providing whatever information investors need to understand the risk in their investment. Private credit is a little bit more complex, perhaps, than other strategies, but investors need to understand the components of it when they jump in. We are very confident that this is an area that has lots of upside potential in terms of the ability to grow this book. And we greatly appreciate that it's also an area that is getting huge demand from institutional investors. We like that you guys are doing it because you're bringing that due diligence required to retail investors to the average individual who can jump into it as an accredited investor. And so that's very important to us, is to support you on this, and happy to see it grow.
Yeah. Well, it's good to have the opportunity to open up the screen there, the curtain, and let people talk to you. So we really appreciate you coming out and spending time with us today.
Same. I thank you very much for having me.
Yeah. Okay, so just in closing, before you make any investment decision, it is crucial to consult a professional financial advisor to determine suitability. We have full disclaimers available on privatedebtandequity.ca. Now, don't forget to follow us on your preferred podcast platform. Visit and subscribe to our YouTube channel to stay updated on new episodes. The YouTube channel is a great way to view the podcast. And from time to time, we have the ability to put up graphics and that sort of thing. We also provide our website visitors with a transcript of each of these episodes. So that if you prefer to read, then go ahead and read rather than watching or listening. If you are eager to learn more about today's topic, please get in touch with me directly, bsimpson@privatedebtenequity.ca, or give me a call, 905-502-0100. That number will be in the transcript if you want to try to find it there. Also, please stay tuned or sign up for a newsletter on privatedebtenequity.ca. We're currently planning as I mentioned earlier, a live series entitled Investing for Income Summit, which will be a 3-part series beginning end of September, early October, kind of one every 3 weeks, with a broad range of panelists like Sean, as you know, if he's able to find the time. Spaces will be limited, so we are looking for a very large audience. And if you're interested, please get in touch. So I am Bob Simpson. It is my pleasure to guide you through this conversation today. Please remember that knowledge empowers you to make well-informed investment decisions. And until we meet again, stay tuned and stay really disciplined on your financial journey. Thanks for listening today.
Thanks very much, Bob.